Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's cut across to the management of United Spirits, who's holding their earnings con call. The stock's up almost 10%, post a strong set of numbers.
Mitra from Credit Suisse, please go ahead. Yeah, hi. My first question was on the growth itself. You've seen a pretty good growth in P&A, but how much of this would you ascribe to, pipeline refilling after the disruptions you had due to the licensing issue? And in a normalized rate, if you could think of, if that was not the case, what would have been the P&A growth? Or if you would want to call out the ex-cost growth as more of a normalized trend on the P&A side. So would be helpful to get some sense on that.
I mean, Arnav, thanks for the question. I don't think that it's material. We monitor secondary sales very closely in our business, and there has been no significant pipeline filling or stock increase that explains our performance. So I'd like to believe broadly that a large part of the performance is underlying, and it has benefited from a good winter this year. And I would say a reasonably good festive and wedding season, right? More the wedding season towards the end of the year. So I would say it's underlying. Now, the point is that we all know that, one swallow doesn't make a summer. It's hard to see how P&A will continue to perform, right? Previous quarter was flat. This quarter was good. What the next quarter will be, we can't tell you for certainty. But we do believe that all of this is because of fundamental underlying interventions that we have made, right, including activation on our brands and a lot of focus from our sales guys to deliver a good quarter. So I'd ask you to read it that way.
Sure. Second question was on the two key costs, which is staff cost and other expenses. So which on the 9-month basis, I think staff cost is down 13%, adjusted for the VRS, and other expenses are down about 12%. So other expenses, you did allude to the bad debt situation, but the staff cost decrease is just too sharp from a normalized your earlier guidance, which was more like a flattish territory. So what kind of explains this kind of a big dip in both these expenses? And more importantly, is it like a new normal of cost, or could these costs come up sharply at some stage because these are unduly depressed right now?
Thank you. Let me answer this, Sanjeev, here. I think first, thanks that you're looking at 9 months and just not looking at the quarter. So as you said, if you look at the 9 months number, our staff cost as a percentage of the NS is close to about 6%, right? And of course, when I just look at the trend as compared to 18 and 19, 18 was about 7.8%. 19 we closed at about 7%. And
Okay, let's welcome our guest on the show today. Joining us today is Shahina Mukadam, who is an independent market expert, and Avinash Gorakshakar of Profitmart Securities. Many thanks to both of my guests. On the show today, we discuss the results from Dr. Reddy's. It was an operationally strong quarter despite a 570 crore loss, and that was due to a one-time impairment. We discussed the strong quarterly performance for HDFC. What does it mean? We asked our analysts about one company whose earnings surprised them on the positive side or the negative side, and we discussed the possible opportunities from the drop in crude oil prices. The first one, Dr. Reddy's very strong set of numbers. Across the board, there was growth that came in. But Shahina, what did you make of the numbers? Stock trading at record highs now. What did you make of the numbers, and what does this mean for the pharma sector? Because it's looking perked up post Dr. Reddy's numbers.
Yeah, despite the one-time write-off that we saw, I think the numbers were very good. A 200 basis point improvement in EBITDA margin is really healthy. And this is despite the not very high growth in the US market. US market, which accounts for almost 36% of revenues, grew by just about 8-9% in top line. So the growth has come from the Indian market, from the emerging markets. So despite this, we've seen a good improvement in EBITDA margin, which is a positive. And going forward, I think they are likely to maintain these margins because we are likely to see lower cost on R&D, lower filing costs, and new product launches. So all in all, it's a a healthy number. At the same time, I think the upside from here would possibly be just about 10% at the most in terms of stock price. So I would be looking at dips to buy it. So I would be more or less neutral, because you have US FDA issues that are continuing to plague the pharma market, and including Dr. Reddy. So I would be a bit cautious.
Okay, what's your sense on the results?
No, I think Darshan, very strong operating metric numbers. I think a very strong growth on the operating profit of almost 24%, and across geographies I think the top line was quite solid. Our sense is that the markets would obviously look at the fact that going forward how would the US markets perform. I think in the management call the management was pretty cautious on the US markets, but other markets they were pretty confident that growth would continue. And as Shahina mentioned, valuations don't appear to be very cheap. I think the stock has run up, so probably one could possibly look at this stock from a longer term perspective only on some declines. But yes, given the kind of numbers which have come out, the EBITDA margin expansion and the kind of growth in the geographies, especially Europe, US and India, I think definitely this could be a good stock in the portfolio for a longer term horizon.
What does this mean because of seeing these numbers? Obviously Torrent disappointed because it has issues of its own, but you think that the market's confidence in the next pharma earnings that probably will come in will improve?
My guess is I think it would be a case-to-case stock specific approach, but I think overall numbers from the pharma sector would definitely improve, apart from the fact that if there are no negative surprises like some exceptionals which come in the numbers. But overall I think considering the second quarter numbers, the third quarter number in terms of top line growth, in terms of margins, and especially companies which export to the US would definitely be I think in the limelight, and I think clearly one should see a better year for FY21 also.
Okay, that's the view that's coming in on Dr. Reddy's. The next one is HDFC, which came out with a very strong set of numbers. Nothing much to complain about. What did you make of the numbers, Avinash? Anything to complain?
No, I think in line, Darshan, I think the only glitch was a slight increase in asset quality, but I think looking at the kind of loan book growth of 16% for the retail side and the management focus on the affordable housing segment, our sense is that this number definitely appears to be very solid in a very challenging macro environment like this. And going forward, I think these kind of steady numbers and asset quality levels should be maintained for the next coming year also. I think probably what the budget announces for affordable housing could possibly act as a near-term kind of sentiment driver, but definitely amongst the best housing finance stocks. Probably one could look at buying at slightly lower valuations rather than currently buying, which appears a little bit stretched.
Obviously valuations are on the higher side, but if someone wants to play the housing finance theme, is HDFC the best pick, or would you like something else?
I would believe housing finance definitely is a very volatile space, and looking at the kind of asset quality stress, housing finance would definitely, I think HDFC would be a better bet. There are other players, but I would believe that looking at the kind of asset quality and the management kind of bandwidth, this definitely is a stock which can give a decent return over the next say 12 to 18 months.
Okay, that's the view that's coming in. Shahina, what did you make of the number? Is HDFC, if someone wants to play this theme, is HDFC still the best bet that they should take?
Yeah, I think so. It's a portfolio stock basically. So really speaking, I would agree that valuation is expensive, but in terms of HDFC, really, one sort of overlooks it just because of the strength of the balance sheet, the management strength, and the way they are growing. Like for example, it is of course the largest housing finance company that we have in India today, and the focus that they have on low-cost housing and individual loans, which now account for I think over 80%. And that is where the focus is. The growth over there is pretty good, 16% plus type of growth, which is decent. And also their ability to raise funds at a lower cost. They have just taken approval for raising another 45,000 crores of debentures. So if the growth is going to come, they have the money. And in terms of cost also, they are able to keep their cost of funding low. So I think, there are multiple factors that make one want to take a long-term bet on HDFC. So I think the numbers also of course were very good, and one has also and another one positive that came in the numbers was the provisioning. They have used the upside that they got in the investment portfolio because of the GRU merger with Bandhan Bank to actually improve or increase provisioning. So I think all in all it's a great set of numbers and a long-term investment.
You think that they will be able to maintain this run rate given the fact that their base is getting much higher, and on the economy front, housing pretty much is on a standstill basis. There's not much traction happening. How are they going to get the numbers in the next few quarters or next few years?
I think in this difficult period when they are able to show this strong growth, I would believe that they would do better than the rest in the sector, and especially that they're gaining market share with a lot of the other players in the market moving out or being hit by one factor or the other. So I think they will keep gaining market share. So it's going to get stronger, and I think the growth they will be able to better the growth that they've shown over here.
Okay, that's the view that's coming in on HDFC. Obviously a portfolio stock, but valuations, remember, is not cheap for HDFC. But if you want to play the housing theme, the largest and the best name currently is HDFC. We are almost 30-35% into the earnings season. A lot of earnings have come in, which probably some of them, most of them have been mediocre, no major surprises coming in. But obviously there will be outliers which surprise positively or surprise negatively. Shahina, any stock that you were really surprised with the numbers that came out?
I like the Titan numbers because I did not expect them to do so well in terms of the overall growth for the jewelry business. I believe that segment was a nice positive surprise. Also in terms today, you have United Spirits, which came out with very good numbers. So I think there are some of these consumer stocks which one didn't expect, because given the low demand that is existing overall. Also for Titan especially, the gold prices were higher. So to that extent, that segment did much better than I expected, and that remains another portfolio stock. The consolidation has happened. If one is looking at the longer term, these times look like where consumer stocks which have done well, it looks like one can keep buying and take the softness in the stock price or the consolidation to add for the medium to
Anything
longer
that
term.
surprised on the negative side?
I think some of the oil stocks really surprised, because to an extent we have had crude oil prices that were low, but nobody really came out with very good numbers citing whatever reasons. So I think to that extent oil stocks have not really kept up to the expectations that one had.
Okay, Avinash, which is that number that surprised you?
No, in fact, on the positive side, Darshan, I think IndiGo came out with their numbers yesterday. I think numbers were much better than what the street expected, and I think on the bottom line, I think that was one positive surprise which took almost every analyst in the market to a surprise. The top line growth was pretty strong, 25%. EBITDA was up by almost 17%. I think the management has attributed that this was largely because of better passenger load utilization. But overall, if you see the kind of commentary which has come in post the Q3 numbers, I think they have been pretty cautious that how would growth pan out in the month of February, and plus with the coronavirus now out, it seems that possibly the Jan to March quarter could be a slightly tepid quarter. But I think I would definitely look at the stock closely, considering the fact that crude prices have come off quite significantly, and that is one factor which would obviously play positively for most of the airline companies, including IndiGo. Okay,
IndiGo is something that Avinash likes at this point of time. And finally, obviously staying with aviation, which could be one of the key beneficiaries. Crude has come down almost 15% from the recent highs. We are asking any stock that probably could be a crude play according to them. Avinash, anything that you think that deserves mention because of the crude drop?
No, I think clearly, B2C players like paint companies, I think we are pretty positive on both Asian Paints as well as Berger Paints. Our sense is that already in the quarter two, the commodity prices were down, so they could manage a decent margin increase. With this kind of drop in crude price, hopefully, if the volume growth perks up both in the residential and the auto segment, we could see better numbers coming out for FY21. And I'm quite hopeful that, Asian Paints is a company which actually has a very strong cost control kind of management. So obviously, one could definitely look at Asian Paints on every drop. The same thing applies for Berger. I think within the given scenario, Berger also looks to be a decent kind of buy, but obviously, at lower valuations.
Okay, so paint companies are something that probably will benefit according to Avinash. Shahina, anything that one should play because of crude that has come off?
I think aviation sector is an obvious beneficiary, because almost about a third of their cost does come and is dependent on crude prices. And we've seen when crude prices are low, aviation stocks do well. And we've seen the numbers that came out, and even just Avinash was discussing IndiGo. I think there the numbers were very strong, and what we've seen is while the costs have been lower, the costs have been maintained, the average yield has gone up. Also, if you see see the average realization per seat has gone up. So to an extent, their margins are expanding. And I think with lower crude oil prices, this is likely to continue. There are some issues with the promoter group because of which the stock has remained, I would say, it has improved, but it has sort of not factored in completely the benefits that are accruing from the crude. But I think this is one stock that one can play if crude oil prices remain low.
Okay, that's the view that's coming in. Paint companies and aviation companies are something that's been spoken about. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guests, Avinash and Shahina. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.